All right, hey, how's it going there? So this snippet, we're going to be talking about some very crucial information. You have to learn and know this to be successful in accounting. What this is that you're seeing on the screen here is you're seeing assets equals liabilities plus equity. Okay, this is what we call the accounting equation, right? This is where we live, eat, drink, sleep, and breathe, and sometimes go on vacation as accountants. All right, this is what we do. This is our life. All right, let's start off with an asset. What is an asset? I'm going to give you the textbook definition because I want to make sure you understand it. They're resources that a company owns and controls. Okay, these are things we expect to have future benefits from. For example, if we have an asset that's called accounts receivable, it's something that people owe us money, and so our future benefit from that is we are going to eventually get the cash from that benefit. Another asset would be equipment. We have this big piece of equipment that we're going to be running and making stuff to sell. Our future benefit is we're going to have sales and bring money in or revenue. So this equipment's going to bring us that revenue. That is what an asset really is for us as a company. Liabilities are our creditors' claims on our assets. So when we borrow money, they have a claim on our assets. In other words, we have to pay them or they're going to come and take our equipment, or maybe we'll have to give them that IOU and then those people pay them that IOU instead of us. So bottom line is that our liabilities is our external creditors' claim on our assets. And then the equity is the owner's claim on the assets. Whatever isn't owed to our lenders, the rest goes to the owner of the business or the owners, whomever he or she may be. Okay, so that's how this works. Whatever assets we have are going to be divvied up between our creditors or the people like from the bank or the people we loan money to, or to the owners of the company. That's our accounting equation. But excitingly, we have our equity section is going to have what we call an expanded aspect of it. Okay, and I'm going to just do this on this Jamboard to kind of demonstrate this. Equity has its own little accounting equation. So let me go ahead and annotate that here for us. Equity is going to have owners' contributions minus owners' withdrawals plus revenues minus expenses. And let me go ahead and just make that a little bigger so it's all on the same line. All right, so this is our expanded equation for equity. So really, our expanded equation is going to have assets equals liability plus owner contributions minus owner withdrawals plus revenues minus expenses. And this is our accounting equation. There shouldn't be any shouldn't be any concerns. If you do have concerns, notify myself or whoever your professor is. But this is important and critical. You must understand this equation. Now, when we have something like, let's say one of our assets increases, then either our liability increases, our equity increases, or we may have a reduction to assets, or some combination of the three. We don't know. It depends on each transaction that we're going to analyze and look at and determine how it impacts the accounting equation. And I will be doing a snippet on going over different accounting equations, or excuse me, different accounting transactions. So that is something that if this is kind of okay, I think I got it, move on to the transactions and go through the transactions so that it'll help you understand. But bottom line, this is an equation. If you love algebra, this is about as algebra as we get in accounting. So if you have any questions on this, shoot your professor or myself a question, an email, whatever, or text or whatever, however they contact you, contact your professor, and I'm sure they'll be happy to help.